Welcome to Cattle Call, an original production of the Nebraska Rural Radio Association. I'm Chad Moyer. Joining me once again, it's Brad Kooima from Kooima Varilek there at Sioux Center, Iowa. And again, a reminder that today's program is brought to you in part by Wolf Auto, Small Town Strong. We make sure you check out their website. They're right there at wolfauto.com. We certainly thank them for sponsoring today's Cattle Call program. First of all, Brad, thanks for joining us. Good to have you on the program once again. And a quick recap of last week's cash cattle market. Interesting. There's a few dynamics we're going to talk about here, but first, takeaways from where we ended last week, Brad.
Absolutely. Thanks for having me on, Chad. Of course, enjoy this program. Also, we finished up, unfortunately. I don't know if I should say it that way, but we ended up the reality of what you and I had discussed, I think, for a few weeks. And that was that it appeared to me, at least, that we were going to lose the edge that the North had to the South in terms of the cash market, right? We've been premium the South for better part of a year. We do the hard work and negotiation up here in the North. We have better quality cattle in the North. And actually, much to their chagrin, we actually have a heavier concentration of packers here too. If you're down in Central Texas, you've got Amarillo and very little else. Like around here, my brother who sells fat cattle, typically will sell cattle to 5 or 6 different packers within, a radius of Northwest Iowa. So, the dynamic, though, that is the driving the flip here, where last week the South ended up at 240 and we ended up at 237, is a fundamental, which is a very macro fundamental, and that is the border being closed for this length of time. 10 consecutive months of record low placements in Texas. Numbers are they're caught up. I mean, their numbers are getting very, very, very short and tight in Texas in particular. And so they've had to start exporting cattle from Kansas to Texas, Nebraska to Kansas, et cetera, et cetera. And that's what's driving the cash market there, where even though they don't do a great job of negotiating down there, and the quality of the cattle isn't the same as it is up here, they're commanding a premium based on sheer lack of supply. So that's how we finished up. We finished up with a futures market that, for the first time in a while, flipped a little bit from a technical standpoint. I know some of these things are boring to some of your people that watch this, but below the 20-day moving average for the first time since before the 4th of July, that created fund selling. You've seen a pretty good drop in the open interest here as the October roll was going on here last week. Funds getting out of October should have been getting back in the back months. A lot of them didn't. The index funds did, of course, but not the trend following funds. So now we're trading below the 20-day. So keep an eye on the 20-day as being, I think, a technical spot where they may sell against it. On the bottom side of it here, we were flirting with being below the 40-day. And I just assumed that for the market's sake that we didn't close below the 40-day. I'm worried that we're going to, I guess, and I think we probably will, but that'll trigger a little more long liquidation from some of the other, speculative funds and others that trade. So we got a softer technical picture here this Thursday than we've had before. But we are still trading at a discount to cash, Chad, and that should help soften the blow a little bit.
All right. Let's go back to something that you said. The dynamic between the North and the South might be changing here a little bit. What is your opinion of the feeling? What is the situation here in the North? Are we as close up as we were earlier in the year, or are there some more cattle around? What are your thoughts on that?
That's a good question, and I think too, I got careful how I answer it. There's a few more cattle standing around than we had. I think you're right on that. Now, is it some burdensome 2015 like problem where we got 1,800 pound cattle? No, I don't want anybody to get that impression. But you and I talked about this for a few weeks already, maybe 6 or 7. The risk here with cheap feed, high price feeder cattle, right, is what? Well, it doesn't cost me $2.40 to put a pound of gain on. Why won't I feed them for another week or 2 or 5, right? Mm-hmm. So we're seeing a bit of that. I can sense that you got a producer that's kind of like going like, ooh, well, maybe we better get rid of some of these cattle now, right? And it'll be a little easier seller than he was here, say, a month or so ago. And the cash market's lower. I mean, we got 245, 3 weeks ago, 4 weeks ago. I got 243 2 weeks ago, 237. I got 237 this morning, which I was happy with, which was steady with last Friday. So maybe we're good enough there as long as the South stays strong. But no, we're not quite as shiny and current and pulled forward like we have been here in the North either. And hey, it's September. The weather's been perfect. The cattle are performing great. These long-fed, farmer-fed calves have a tendency to be a little bigger, and they have a tendency to maybe be a little more patient with their marketings, if that's a polite term. So yeah, it's not a wreck, but we're not quite the pulled ahead super current thing that we had been, Chad.
All right, very good. We did have a listener question that was submitted. We'll go ahead and do that now. And since we are talking about risk management, it'd be really good to hit on this. Question is, how exactly the livestock price insurance product that is out there, how is that premium figured out? Is volatility a factor? And then even bigger picture, how does that then fit into our overall marketing plan?
Well, this is a nice question. I'm going to do my best to answer it. I'm going to preface my comments by saying that if I sound like I've got a bias, I don't mean to. We offer this insurance product here at our office as well. My two partners are both licensed to do it, so it's not as though I'm not a hater, okay? But I also have a little bit of a perspective on pluses and minuses generally, and we'll get into that of why that strategy might fit someone and may not fit everyone. But to answer this person's question, this is a very transparent way that premiums are calculated. Is volatility a factor? Well, it is, in that these premiums are determined by what option values are on the futures market. Okay, whether it's feeder cattle, the contract, the LRP for feeder cattle is a better product in my estimation than the live cattle product. I can get into that later on. But let's just say that feeder cattle option, whatever that option is, that's what drives the premium. Whatever the cost of that option is, publicly traded. Now, when we're in high volatile times, options are higher for everyone, whether you're using the LRP product or whether you're buying the options yourself. So the premiums are generated based on what that is. Then, of course, government subsidizes to the tune of 30 to 35%. So if you've got a $10 put option and it's subsidized at 35%, you're going to pay $6.50 and a nice healthy commission to the salesman of that insurance product. So that's how the premiums are determined, and we can. If you want to dig a little deeper into the pluses, minuses, or maybe of that instead of some of the other things that you can do for risk management or risk mitigation, we can sure talk about that, Chad, if you want.
Yeah. Well, let's just take it to the next. We don't have time in today's program. I think we could do a whole seminar on this. Other people have done seminars on this. But how do you view this product, this LRP product? How does that fit into a farmer feeders, feedlot owners, managers risk management plan?
Okay. Good question. First of all, the regulators did wake up and figure out that they needed to do a few things to clean up some of the abuse is a strong term, but that's the term that comes to mind. So they've eliminated this subsidy harvesting thing, which is I'm glad about, and I've been yelling about it for 2 years. So I'm glad to see that's been done. Okay, so I'm going to break it down into a couple of things here. So first of all, the feeder cattle contract is a cash settled contract. So the basis is very reliable, right? If you're buying a January feeder cattle LRP, you know that it's going to go off the last Thursday of January. It's going to have a hard price, a cash settlement price, and you should have a fairly reliable basis on whatever you think you're going to sell your 900-pound steers for at a given sale barn or whatever versus whatever the futures are. So it's pretty reliable. I guess it's okay. Okay. To me, there's other things you could do, buying a put, selling a call to cheapen up that 30 or 35% subsidy and still be the captain of your own ship and decide maybe you want to sell the cattle when they weigh 800 pounds because people are nuts enough to give me a big price for it, or maybe I want to change my mind. The LRP product becomes a much more fixed type thing. But if you're a backgrounder, I think there's a place for it, at least for you to research and look at it. Now, the live cattle product I don't like nearly as well. It's based on a sort of a cash cattle market. Well, you tell me what the cash market is. I just went through it. There's a $3 difference between Kansas and Nebraska today. It also is a product that has a date where, okay, you're going to sell cattle on, I buy these 900-pound cattle today, and I know they're going to be harvested on February 11th. How in the world would I possibly know that? There's no way to know that. Whether the basis, if I'm a hedger, I pull cattle forward like we talked about here the last 6 weeks, 2 months, right, Chad? I mean, we like the basis. We took advantage of a good basis, so you can do that, liquidate your own hedge. You can't do that with the LRP live cattle product. Or you can't change your mind based on weather, or the cattle just didn't flat perform, or they overperformed because the weather was so mild like they did last winter. So I don't know if that's your jam. I guess it's so it's around a 101 product, and I think most of us should be a 201 or a 301 marketer. Is that fair?
It's a good place. It's a good place to get started, get your feet under you, and then continue to refine and develop your risk management plan from there, huh?
You said it much better and more politely than I did. Thank you.
All right. Oh, cool. All right. We just got time for one other thoughts here. Looking forward, we do have a cattle on feed report tomorrow. I believe the pre-report estimates on feed is down, 1%? Placements down, looks like 9%. Marketing's off maybe 13%. Thoughts on what you're looking for there, and then just the rest of the week's cash trade.
Right. Okay. I think let me back into that question. I think cash cattle will sag into the end of the week. I'm more of a thinking where go ahead and try to take these steady prices this week maybe is a better idea than trying to fight it. But we'll see. 237's kind of been established so far in the north. It's starting to back up a little bit from that. So I'm gonna say steady, softer going into tomorrow. You're right. The report tomorrow should be interesting. Again, placements are the one number that probably people are going to look at first, Chad, and guessed at 91%, and largely influenced by what looks like Texas is saying that their placement numbers. So I get a read on what Texas does from one of their organizations, and they're guessing that's like 80% again. So Texas is a big state and factors big into the U.S. report, of course. So a placement number at 91. I guess I don't have too much argument with that. That marketing number is really disappointing at 87. We do have one less market day, which is about 4%. But this notion that we hit on earlier in the program in your show, that maybe we aren't quite as current, would also fit that lower marketing number. People say to me, Brad, how can we have 1% less cattle on feed when we're killing 7% year to date? Mm-hmm. I don't know. Okay. I can explain part of that away. With beef on dairy, where they're fed for 420 days. So they get counted over and over and over and over. They're on feed forever. Right. I can maybe explain it a little bit because maybe we are holding a few cattle a little longer. Maybe
heavier weights, possibly.
Right. Or maybe their core numbers are wrong. Maybe, I think that there's something to be said for that too. I've always felt like the herd side. Now, one thing I'll leave this with, I know we're getting on time here, but so that'd be the lowest fed cattle marketings in August, if it comes in on that guess, since 2015. I don't know if you were trading cattle futures in 2015, but it was a wreck. Okay. Mm-hmm. I mean, okay. The number of cattle placed will be the smallest since August of 2015. I'm just trying to lay this out here that, if it's as simple as, well, Brad, the numbers are tight, so we're going to go up every day. That was not the case in 2015. I mean, there are other market factors, and that big factor then was the pit closed, in my opinion. But I just throwing that out there. Folks, be careful. Do some risk mitigation. Use your head. Let's not give it back. We just made a chunk of money here, and let's be prudent about defending them.
Yep. All right. Very good. Good to have you on. I appreciate the expertise. Thanks, Brad.
You're welcome. Thanks for having me.
All right. And then, contact information. You'd love to have conversation, right?
Absolutely. There's our website. You can sure look at it there, but we'd rather talk to you. 712-722-0023.
That's Brad Kooima and Varilek at Sioux Center, Iowa, on today's Cattle Call program. Again, hit that subscribe button. Put a question in the comments below. We'll come back and talk about it on the next Cattle Call. Thanks for joining us on this week's Cattle Call. Again, it's brought to you by Wolf Auto, Small Town Strong. Have a great week. We'll talk to you next week on Cattle Call.